Good morning, everyone. I hope you're well. We'll just wait for a few people to dial in for the next couple of minutes, or next 30 seconds or so before we start the webinar. I hope everyone's well this morning.
Morning, everyone. Hope everyone's okay.
Obviously, we have Alex Brandreth from Luna, as per usual, giving the quarterly webinar. And we're just getting some people dialing in now. So we'll press on. Obviously, welcome everyone. And I think it's fair to say, Alex, since the last webinar, there's been a few changes, both in the economy and the political system. Saying that, there's been 4 different chancellors and a couple of U-turns. If it's a double U-turn, does that mean we're back on track?
That's where you started.
So, so as the Chancellor confirmed Parliament on Monday, he's largely reversed most of the growth plans, measures from what Kwasi said on the 23rd of September. And then on the 1st of October, we've got the medium to long-term fiscal plan and the forecast coming from Office for Budget Responsibility. But God knows if anything will change in this space. But what I'd like to stress to all of our clients is that even though we may not have been through these exacting times at the moment, we have been through times of market volatility and uncertainty. And at Pareto, we've always advised our clients to invest in a well-diversified portfolio across all different asset classes, geographical areas, and the industry sectors, as no one asset class, geographical area, or industry sector, ever consistently outperforms any of the others. So by having a well-diversified portfolio that constantly rebalances, which with the help of our fund managers such as Alex, we expect our clients' investments to be able to outperform the markets while reducing some of the volatility that we've seen over the last 3 to 6 months. But what I would stress is clients who have invested over the medium to long term, and during that medium to long term, we will experience some short-term volatility. So our advice, as it has been during volatile times in the past, is to sit tight and wait for the markets to recover. And then along with your advisor, sit down, review your portfolio, your needs, priorities, objectives, your risk, volatility, and capacity for loss. So what I'd like to do is pass you over to Alex Brandreth, the Chief Investment Officer from Luna Investment Management. There are some good news, Alex. I believe you've been included in the top 100 fund managers in the UK. And Alex will discuss what's happening within the markets today. So during the presentation, Alex will be looking at what's driven this volatility, the impact of inflation and interest rates upon the markets, the effect this has had on the markets and your underlying investments. So just before I do pass you over to Alex, there's a wee bit of housekeeping. Can I ask you to check that everyone's on mute? You should be, but that's just to mitigate any background noise. Just for your information, the presentation is being recorded, so if anyone wants any copies, we can get that out to you. The webinar should last around about 40 minutes, with questions and answers at the end via the Q&A button on the Zoom screen. So without further ado, I'll pass you over to Alex Brandreth, Chief Investment Officer from Luna, excuse me. Over to you, Alex.
Thank you, Stuart, and thank you for Pareto for asking us to do this quarterly webinar again. And most importantly, thank you for dialing in and listening today. It's clearly been a very volatile quarter, as Stuart's highlighted. Probably feels a bit more like that in the UK than anywhere else globally at the moment, given the political change and U-turns that we've been going through. It's certainly been an interesting period to be invested or just resident in the UK. I'm just going to share my screen then and share the presentation for today. Thank you to Stuart for mentioning the top 100. I mean, whilst it's nice to individually be recognised for that award, you know, it's very much a team approach at Luna, and we all pull together, and it's a shared success across the whole team. So, you know, thank you to the team for all the hard work that we've done over the last 3 or so years now. So, moving on to the quick introduction, what we'll go through today. as we touched on, it's been a very volatile period for investment markets, and that's been driven principally from very low investor confidence. This has been principally the main driver this year, and I think that's very much got a lot to do with the reaction to markets from the mini budget that came through. Confidence is already pretty low, and any country, any company that really stands out and tries to do anything really different at the moment is getting punished by the markets. And we see it with individual companies, but the UK really stood out alone in terms of the decisions they were making, and was really punished by the markets. And we'll touch on some of the rationale for that. Where's that low investor confidence coming from? It's the same three drivers that we've been mentioning all year, really. Inflation and the response by global central banks. Interest rates have been increasing gradually over the course of this year. In some countries, like the US, quicker than others. We've already touched on the political backdrop within the UK, but there's, of course, a number of geopolitical matters that are still ongoing. The most obvious being Russia's invasion of the Ukraine, and that's still rumbling on, which is, most importantly, incredibly sad that that's still going on. But there's also been geopolitical decisions going on in China. There's been concerns about what could happen in the future, and their COVID strategy as well. And if we go back 20 or so years, there used to be a very important saying, which still rings true today, that when the US sneezes, the rest of the world catches a cold. Well, it's almost just as important to expand that now to say if the US or China sneezes, the rest of the world catches a cold. And China has been going through a raft of restrictions to minimize the spread of COVID. And that's had a very big impact on global supply chains. It's had a big impact on the Chinese economy. And that's really impacted global growth this year as well. And I think that that's probably not as talked about as maybe it should be. And that's still ongoing at the moment as well. All of those points that we've mentioned, Russia's invasion of Ukraine and the surge in commodity prices, problems with global supply chains, that has been the principal driver behind inflation this year. My estimate and our estimate is that inflation is always going to pick up this year because it tends to do as you're coming out of a recession, as we came from COVID. I mean, this was meant to be, or is, the first full year of all restrictions being eased. So demand was going to be a lot stronger in 2022. So it was expected inflation would pick up anyway. But what's supercharged has been this increase in commodity prices, as we know from energy and oil prices. And we've got a little bit more that we'll touch on that later. It's not all bad news. It feels like it at the moment. I had 4 notifications before 7:15 this morning from the Telegraph, BBC, Sky and Bloomberg, all telling me about the cost of living crisis and how bad things are in living in the UK. And we'll show a chart later on what consumer confidence is like at the moment and what this bad news and press speculation and press-driven agenda is impacting us as a society. But as I said, it's not all bad news. The employment market is incredibly strong. We had UK unemployment rate data out last week, which showed the UK unemployment rate is at 3.5%, which is the lowest it's been for nearly 50 years. So there is a lot of good news. It's also 1% below pre-pandemic levels. So the UK unemployment rate in 2020 was 4.5%, and we're now at 3.5%. So that has a positive impact as well. That has an impact on wages, and that, being employed is a key impact onto the overall economy. As we've touched on now, the political change in the UK has had an impact on a number of asset classes, the most principal ones being sterling, the exchange rate, and also the bond market. I'm not going to dwell on those now because we'll touch on them in a little bit more detail as we go through the presentation. And what's been driving those concerns and the volatility around those asset classes is debt. We are heavily indebted within the UK. It's not just specific to the UK, we're heavily indebted globally. And those debt levels, because of the announcement from the mini budget, we're going to increase even further. And that's what overseas investors became nervous about. So that has been the principal drivers behind the nervousness from investing within the UK. So this is a presentation slide that I showed last time, and it's meant to symbolize the challenge that central bankers have got. The challenge that central bankers have got is that they have a dual mandate. They have a mandate to try and keep prices stable at inflation levels. And most central banks, the UK and the US, have an inflation target in each country of around 2%. So we saw the inflation figures come out this morning within the UK. They were slightly higher than it was expected. So CPI, consumer price inflation, has come out at 10.1, picked up from 9.9 in the previous month. It was expected to be around 10%, so it's a little bit more than the market was expecting. So sterling's been impacted slightly today. That takes it back to the levels it was in July. So it's a level that we've become very accustomed to, which is probably not something that we should be happy about. It wasn't just CPI that was announced today. We also had retail price inflation, or RPI. That came out at 12.6%. Now, RPI is an interesting one because it's actually getting phased out by the government. They don't want to use it anymore, and it'll be phased out by 2030. But a number of operators still use RPI to increase prices. So I use O2 for my phone bill, and I got a letter through earlier on in the year saying my phone bill was going up in line with RPI, which I thought was quite cheeky of O2 to be able to do that, but just goes to show that, it's not just the inflation that is within CPI that we should be aware of, it's also the retail price index as well, which is a lot higher. Now, I've already touched on some of the main drivers behind why inflation is high this year, energy prices being the obvious one. The announcement by the government will cap that for a period of time. But one of the biggest increases from the data today was food inflation and food prices. That's starting to tick up, and that's having an impact. The other big impact that we've seen this year is the oil price, and the oil price has increased still significantly from a year ago. So the inflation numbers that were announced today compare inflation in September to September of last year. So clearly that takes into account the Russia's invasion of Ukraine and the spike that came to global commodity prices. But as I said, central banks have got a dual mandate. On the one hand, they want to keep prices stable, but they also want to keep economic growth going. And we're going through a period of weaker economic growth at the moment. And I've got some stats on that shortly. But within the UK, we've had a couple of announcements recently in terms of what economic growth is doing. So economic growth for in the second quarter was revised up. There's a number of releases for economic growth on a quarterly basis. There's normally 3. So the second one that came out showed that economic growth contracted. The latest release came through and said that economic growth actually expanded by a staggering 0.1%. So economic growth within the UK in the second quarter is basically flatlining. It's not growing significantly, but it's not contracting either, is the message to take from that. But as well as doing quarterly numbers, we often get monthly readings, which give you a bit of a more short-term kind of headline figure of how the economy is doing. And we've just had the August data through last week. And that August number showed that the economy contracted by 0.3% in August. So as I said, I mean, these numbers should be taken with a pinch of salt because they are often revised, as that Q2 number suggests. It's gone from a negative to a positive. But it is, a bit concerning that we have seen economic growth contract in August. I don't think it's unexpected. That probably means that the third quarter, so the period we're in now that we've just finished, between July to the end of September, was probably a negative quarter. And technically, if we have a negative quarter in the final quarter, the quarter we're in now from October to the end of December, that technically means that the UK would be in recession. I don't think that's anything to be concerned about. I mean, clearly it's disappointing that the economy is contracting, but recessions happen, and there's also different degrees of recession. The financial crisis and COVID were very deep, severe, longer drawdowns to recession. We had as I mentioned on the last call, we had a double dip recession in 2011 when the European debt crisis was going through and people were concerned about Greece's finances. And that was a very short, shallow recession. And kind of given the data is only just negative at the moment, it's starting to lean into that camp that is at the moment a very short and shallow recession that we're in now. Now, it's not just central banks that are going through this challenge, it's also the government. So apologies for using the same slide, but it just highlights that everyone is in a very similar difficult situation. And the government are in a very tricky position as highlighted. There's not a lot of wiggle room at the moment. They can't come out with any stimulus packages. They've just announced the biggest budget for 50 years and spending package, and look at how the market and the voting population have reacted to that. So there's very little wiggle room for the government, because on the one side, as I mentioned, we still have high levels of debt. We've got some charts on that later just to highlight how much we have. And this is the highest we've had outside of war. So it's a significant level of debt that we have. But on the same side, the government want to support the economy. They want to protect the consumer. They don't want the economy to be struggling, particularly as there's now 2 years or so to the next general election. They want the economy firing as they're going into the next general election. And I mean, we've already highlighted on the weaker economic growth figures and the inflation figures, but that's the challenge that this government now have. There's very little wiggle room in support that they can do. Just taking a step back, and on the left-hand side, it just shows kind of how much global growth has slowed in our expectations this year. So this shows where we were at the beginning of the year and what was expected, and how far growth has been revised lower. So for the US has been hardest hit. So as we were coming into this year, the US was expected to grow by around 5%. That's been revised down closer to 2% now, just a little bit higher. You can see the impact that the Chinese lockdowns have had on the Chinese economy and expectations. The UK and Eurozone are being very similarly impacted. That's principally driven by the cost of living, inflation, and natural gas prices, and the oil price increase, which is impacting us, and Japan to a lesser extent. So global growth is certainly slowing. The IMF have come out with predictions this year that the global economy will grow this year, but it's going to grow by just over 3%. And they've just revised their expectations down for next year that the global economy will grow by 2.7%. And the purpose of telling you these numbers is, I mean, the IMF are always wrong, so they'll probably be revised higher or lower, and who knows what will happen. I mean, no one foresaw the war in Ukraine this year and the impact that that would have on commodity markets and just the global economic growth situation. But the purpose of showing them is that the global economy is still expected to grow this year and next year. Now, I don't think that's really discussed or highlighted enough. People talk about the fear of recession and the risk of that coming through, but equally, when restrictions are eased in China, and it will be at some point, we've seen it within the UK, then that will have a big boost on economic growth. And there are other, if perhaps the war in Ukraine were to stop, that would have a big impact on commodity markets, and that will reduce inflation, and that would have a positive impact on the economy. It can't be seen right now, and sometimes it's difficult to see the wood for the trees in these situations, but there's certainly scenarios that could play out over the next 6 to 12 months. I feel like we were saying something very similar in COVID. We didn't know when the vaccine was coming, and then it was announced at the beginning of November, and it had a major impact on the way that we live our lives, but also the equity market and bond markets at the same time as well. Now, on the right-hand part of this chart, it highlights US, Eurozone, and UK Purchasing Managers Index, or PMI. Well, what is that? That gives you a direction of economic trends right now. As we mentioned, GDP growth is a bit delayed. We've just had the August reading, and it's probably going to be revised and revised again. So the Purchasing Manager Index will give you a good guide of what's actually going on right now within the economy. It looks at both the manufacturing and service sectors. So this chart goes all the way back to 2010. You can see how the Greek sovereign crisis and worry about European debt really impacted Europe during that period, but it also saw the US and UK come under some stress. Sorry, this orange dotted line here is obviously number 50, which represents above this line, represents that economic growth is expanding, whereas below this line suggests that economic growth is contracting. So that's why that 50 is highlighted. You can see that Europe was contracting in 2011 to 2013. The only other periods of real significant contraction have been around COVID, and then the second wave that came through here. And you can see the impact that that had on global nations and how far those readings actually fell compared to the recession that we went through in the European debt crisis. Now, at the moment, those readings have just dipped below 50, which suggests, as I said, we are going through a mild contraction in economic growth, but it hasn't fallen to the levels of COVID or the global financial crisis yet. So that's why we're leaning towards the fact that at the moment, it looks like a very mild, short-lived recession. Some good news. I mean, it doesn't feel like it at the moment when we're highlighting inflation at 10.1% today, but inflation is close to peaking. And on this left-hand chart, you've got US inflation, European inflation, UK inflation, which is clearly most important to all of us today on the call. Actually, from an investment perspective, though, it's probably US inflation that matters the most because that impacts the Federal Reserve, and the Federal Reserve have a bigger impact on global markets. But anyway, you can see here that inflation and predictions from economists are expected to come down. And you can see this is almost the worst possible point. For the US, actually, US inflation has fallen for the last 3 months. It's not falling to the extent that maybe the Federal Reserve would like, but it is moving in the right direction now, and it's starting to come down. The UK and Europe are a little bit more elevated now because of the natural gas price. Natural gas prices in the US are significantly lower, and they aren't impacted to the same extent as we are as with the problems with Russian natural gas. So that's why UK and Europe is expected to stay stubbornly higher for a bit longer. But there's a number of reasons why inflation is expected to fall next year. Well, if we are technically in recession, then that means that prices should be expected to go lower. There's a great saying that the cure for high prices is high prices. And that's because if suddenly you can't afford to go and pay something, then you won't go and pay for that. You'll change your habits and you'll change your behavior. And that ultimately forces prices down because the demand for those goods reduces. And there's certainly some signs of that at the moment. The Aldi chief exec was recently talking about how strong a period they're going through at the moment, how people are perhaps trading down. Maybe that's a little bit unfair on Aldi, but nevertheless, it's certainly something that's been discussed in the market at the moment. August was one of their busiest ever months. But there are other reasons why inflation is likely to fall down. One is that commodity prices spiked and peaked in March of this year, in April, when the war was at its most heightened point. And as I mentioned earlier, inflation is an annual calculation. So when we're comparing prices in March of next year to March of last year, then that means that commodity prices will have actually fallen over that time period. The oil price, to highlight this, got to $140 at the peak of the Russian invasion, whereas today it's closer to 95. So it's fallen by roughly a third over a very short time period. So that is why one of the biggest drops actually comes in the end of the first quarter and beginning of the second quarter next year, because you'll see those fall in energy prices, which will have an impact, and a fall in the oil price as well. It's not just oil that's fallen though. You're seeing commodity prices in general fall from their highs. If we are in recession now, then other commodity prices have come under pressure, like iron ore and copper have fallen significantly from the highs earlier on in the year. It's not just things like that. I mean, it's also the global supply chain. The cost of shipping has been astronomical since COVID because there's been a lack of ships. And what happens when that's the case is people build ships, they get them out and they improve the global supply chain. COVID is less of an impact, apart from in China, than it once was. So that means that the global supply chain is fixing itself and global shipping costs are falling through the floor. So that means that the cost pressures that some businesses are facing are also starting to fall. So there's certainly some positive news coming through with regard to inflation. On the right-hand side of this chart, you can see job vacancies. We've highlighted already how strong the employment market is in the UK, but that's the same situation globally as well. You've seen a number of people leave the workforce because of COVID. Perhaps that's to go and help or elderly relatives, or just simply because COVID was the final straw that broke the camel's back in terms of just wanting to leave the labour market. And you can see that we are still very close to record job vacancies. That has come off its highs. The uncertainty that we're going through at the moment is starting to have a little impact, but we're still at very elevated levels. And that's principally one of the drivers between high wage growth and wage inflation. And I'm just going to, instead of talking about the left-hand chart, I'm going to start with the right-hand chart. And that just shows you that low unemployment rate that I've already highlighted already. But when you get low unemployment, that means you also get high wage inflation, because people are competing and want people to join certain businesses and organisations, so they tempt them with higher and higher salaries. So at the moment, wage inflation within the UK is running around 6%, which doesn't get talked enough about, really. I mean, that's a very high number. That's the highest number since kind of 2007, just before the financial crisis hit. It's a very high number for wage inflation to come through at. But the reality is, as we touched on, wage inflation is running at 6% and consumer price inflation is running at 10%. So that's a 4% gap, which is what the cost of living crisis is. We're all feeling poorer by around 4% at the moment on average because of the inflation that we're having within the UK. But as I said, if you fast forward the clock 6 months or so, then you could even easily see parity between wage inflation and consumer price inflation, which means that the cost of living crisis will potentially not be talked about as much anymore. Now, on the left-hand side of this chart, we've used the services PMI, which is the similar purchases manager index, but based around the service sector, because that's really what matters within the UK. We're a consumption-based economy. And you can see the past impact of other recessions that we've had. This chart goes all the way back to 1998 to where we are today. So you can see how impacted services is at different time periods. That's the financial crisis in 2008, 2009. You can see how short and sharp the COVID one was and the subsequent second lockdowns. But you can see it has fallen from its recent highs, and it's just gone below that 50 level that I mentioned earlier and into contraction. On the other line on this chart is consumer confidence, which is this purple line, and that's based on this right-hand scale. Consumer confidence has never been this low, and that takes into account the financial crisis, and that takes into account COVID. And that's important to be recognised at the moment, and confidence has a big impact on the overall economy. And that's technically why we could be in recession at the moment, because confidence is so low. But the other point that I would highlight in this chart is that confidence does bounce back very quickly. It's bounced back very quickly after COVID. It bounced back very quickly after the financial crisis. It doesn't tend to stay depressed for very long periods of time. We appreciate it probably is one of the darkest points now, because we're at peak inflation and we've got the Bank of England increasing interest rates, which we'll touch on shortly. Now, this is the joys of doing these presentations, that suddenly the slides that we have go out of date very quickly. And this was put together before the U-turn by the government, just to highlight kind of why the market and reacted so badly to the announcements in the mini budget. And this shows the EU, European nations, and the UK highlighted in orange there. And it just shows the current budget deficit. And the current deficit is just over 2%. And it was forecast by the National Institute of Economic and Social Research, NICER, that the mini budget would move the UK deficit out to around 8%. So you can see how quickly we would be increasing the amount of debt that we have, that's just on the 2022 figure. So we'd be moving fourth within Europe between Malta, Belgium and Italy, whereas the UK beforehand actually had a slightly better budget deficit than the European average. And hence why we've now had a big U-turn. The government bond market reacted very badly to that news, and as did sterling. And the reason for that is what we highlighted earlier, is the amount of debt that we have. So this chart goes all the way back to the early 1970s. Interest rates is that wiggly line there, which is black. And I'll touch on where we expect interest rates to go and what the market we're expecting interest rates to go on in a second. And then you've got the overall debt within the economy in these stacked bars here. You've got the government level of debt there in that kind of marine color. You've got household debt, and you've got non-financial corporation debt, which is on top. Now, if you go back all the way to the late 1970s and early 1980s, the amount of debt that we had to the size of the economy was around 100%. That meant if the UK economy was about, say, 3 trillion, for argument's sake, we had 3 trillion worth of debt. You fast forward, go through the 80s and 90s, you go through the 2000s and you go through the financial crisis, and gradually as a country and in a nation, we've amassed more and more debt as a percentage of the economy. COVID then hit and we had another increase of debt levels because of schemes like furlough and the fact that the government receiving less tax receipts at the time. And we're now at a situation where debt to the economy is at 300%. So if the UK economy, let's use that same number, is 3 trillion, that means we have 9 trillion of debt within the UK now. It's increased 3 times over the space of 40 years. That's an incredible increase in the amount of debt. And when you have such an increase in the amount of debt, one of the biggest impacts that comes through is the cost to service that debt. And the best way to think about the cost of service to debt is interest rates, because that's what we pay our mortgages on, that's what we pay credit cards linked to, that's what debt is linked to. It's linked to what the Bank of England say is the marginal cost of borrowing. And in the 1980s, when, okay, we still had a lot of debt, but we had a significantly smaller proportion than we did today, the economy could withstand higher interest rates because we had a lower amount of debt. The economy now can't withstand the same level of interest rates as we did in the 1980s and 1970s because we have so much more debt. A small increase in interest rates now has a bigger impact on of the amount of interest that we pay. And it's not just at the household level, but it's at all of the levels here, government levels as well, as we've touched on. So after the announcement of the mini budget, it was expected that UK interest rates could hit 6%, which doesn't seem a lot, but remember that almost takes us back to the levels that we were in a pre-financial crisis. And over that time period, UK debt has gone from 200% to 300%, which to me doesn't make sense and would just significantly impact the overall economy too much. Now that we reverse on the mini budget, the forecast is that UK interest rates peak at 5%. Personally, I still think that's too high. I think UK interest rates will probably peak in the next 6 months at maybe 3 to 3.5%, maybe even 4%. But they can't go back to the levels, definitely not of the 1980s, and they'll even struggle to go back to the levels before the financial crisis for this fact that we just have this amount of debt at the moment. And if we're right about inflation, and inflation has peaked and starts to come down over 6 months or so, then that's certainly going to take some pressure off central banks to continue to increase interest rates. Now, as I mentioned, interest rates in the UK are at 2.25, so there is scope for interest rates to continue to move higher over the course of this year. And the inflation announcement today probably means that there's going to be a 50 to 75 basis point increase. So we'll go to 2.75 or 3% at the next meeting, which is not too far away now. But the UK's debt level is not different. We're not special. This just compares us to some developed nations on the left-hand side in the green bars and some more developed nations in these blue bars. This is a range that we've operated within over a long period of time. You can see where we are in the current 2020 forecast, which are these diamonds, compared to where we have been in historical ranges. You know, Japan stands out as a nation that has had withstood high levels of government debt because they had their financial crisis in the 90s. But the UK is very similar to the Eurozone, but there's certain nations like the US which have significantly higher levels of debt than the UK. And on the right-hand side of this chart as well, you can just see those numbers just in a slightly different way. So I just skipped on there and just show how global debt levels have increased gradually since the early 2000s in the US, UK and Eurozone. Now, this is one of the most important charts to highlight right now. And we've been discussing this probably more so with clients than we have done for a very long period of time. And it's just really to highlight how markets and the economy move together. Within this blue line, you can see what's going on with the economy. The economy goes through expansion, it peaks, we have recessions, we go through cycles all the time. We have troughs when we go through recoveries and expansions. And this red dotted line here just highlights what's going on with the market. And you can see the market moves before what's going on with the economy. And typically that is about 6 to 9 months that the stock market moves with what the economy is doing. So I'm sitting here today, I'm telling you that the UK is probably in a very shallow recession. We're probably down here, but the market, as we've seen this year, has already moved significantly in anticipation of that. And we highlight that in some of the charts that we'll show later that individual markets and parts of the market have been impacted more so by that factor than anything. So, and it's actually a strange fact that some of the best returns that you get from stock markets is during this period here, when the economy is technically in recession and troughing, but you can start to see the recovery coming through. Now, who knows when that period will be, but we might not be too far away from that period. So as I said, some of the best performance for stock markets actually becoming a new recession. And just to highlight a few of those, the low in stock markets during 2020 was the day that Boris Johnson said that we were going to a national lockdown, the 23rd of March. You would not expect the low of the market to be when things felt at their darkest, but it was. In 2009, when we were going through the financial crisis, the low was again in March 2009, but the UK economy didn't emerge out of recession until the end of 2009, so highlighting that 9-month lag. So if you're thinking about where the market is going today, let's fast forward 9 months and think, well, that's actually in the middle of next year. Inflation will be coming back down then. Interest rates might even be coming back down then as well if the Bank of England are looking to support the economy. And that puts us in a significantly different situation than we are today and what we're looking out forward for. So that's all on what's going on with the economy. I'm just going to highlight kind of some charts on the impact on this has all had on markets and just provide a little bit more information there. So the first is sterling. This chart goes back to before the financial crisis in 2008. People were going on holidays to the US. We were getting £1 to $2. You felt very rich when you were in the US. That's why so many people were going there. And over the last 14 years or so, sterling has come under pressure compared to the dollar. And there's probably a number of reasons behind that. The first is that the dollar is a safe haven currency. Investors flock to the dollar in times of uncertainty. And that's exactly what happened in the financial crisis in 2008 and 2009. You can see how quickly sterling fell during the financial crisis relative to the dollar. Clearly, the other big significant impact since then is the Brexit uncertainty in 2016 and the impact that had on sterling dollar. And then you can see again more recently that sterling's been under pressure, and that's, well, in part due to what the government have done, but it's also linked to the fact that this year has been another uncertain year. So investors have flocked to the dollar this year. And the US Central Bank, the Federal Reserve, have increased interest rates quicker than the Bank of England have. So that makes the US a slightly more attractive place to invest when you're looking for a low-risk government bond investment, because you're getting a higher return in the US compared to the UK. So investors move more assets to the US. And that trajectory looks like it will continue because the Federal Reserve are likely to increase by 0.75% at the next meeting, and it's only a slight possibility that the UK does at this stage. That being said, sterling has bounced from its lows. At the worst point after the mini budget, it got down to about nearly parity. It got down to 103. Today, we're about 113. But there's a number of consequences of sterling being weak. It's probably another inflationary force because we import another lot of goods from different countries into the UK. Obviously, as I said, if you're going on holiday, it feels terrible at the moment. And it's not just against the dollar, it's against other global currencies as well that you're seeing the same impact. So it's going to squeeze if we're all going on holiday. But from an investment perspective, it's not necessarily bad news. The FTSE 100 derives 70% of its earnings from outside the UK. And this is the point that everyone missed during Brexit. Sterling being weak actually acted as a positive for the FTSE 100 because all those earnings got a one-shot boost with sterling being weak. And again, that impact can be felt again this year within the FTSE 100 as well, that overseas earnings will be having that positive impact. As well as that, Aluna, if we're buying bonds or Facebook or US companies, for example, then we don't hedge the currency. So that means that we're buying those companies in dollars or those bonds in dollars. And if sterling's weaker, it means that the dollar's going higher. So it's not been a bad point from a portfolio perspective as well. Sterling's been weak this year. It's been the worst year on record for bond markets though. This just highlights how bond markets, different types of bond markets have performed this year. You've got government bonds or gilts, which have fallen by a staggering 26%. This is to the end of September. They have recovered somewhat over the last week or two since the U-turn by the government. Corporate bonds within the UK, so buying bonds from Marks and Spencer's or Tesco's, are down roughly a quarter this year. And you can see if you're buying strategic or emerging market bonds, you've also lost a significant amount of money as well. That's principally been driven by inflation and interest rates. And that's been the key driver behind the bond market. And the bond market is, you look as a gilt as a risk-free, safe asset. And this just highlights, well, it's been anything but that this year. Fortunately, from a Luna perspective, we were pretty underweight bonds. We didn't like bonds because of this fact. We've actually now started to buy some more because the return that we can look going forward from bonds is significantly more attractive after the falls that you've seen this year. Equity markets have also had a challenging year. There's been very few hiding places to hide this year. As highlighted on the chart, the bond market's lower, equity markets are lower. The FTSE 100, our local stock market, has been the best performing global stock market. It's only lost you just over 3.5%. Whereas if you've been invested in technology, NASDAQ, it's closer to a third. Hang Seng has been impacted, that's the Hong Kong stock market, by the impact of COVID and Chinese restrictions. That's down by about a quarter. And the Russian impact has probably been most felt in Europe, and that's around 20% or so lower. The other purpose of showing this chart, though, is that markets are at very depressed levels, but they can also bounce very strongly. And the quarter that we've just finished actually started with markets rocketing in July. There was significant returns made in July. I think the S&P was up something like 12%. The NASDAQ was up somewhere like 18% during July. We had a very strong start to the quarter. And it's easily possible that you can see something like this as well. When markets snap back, they tend to snap back very quickly. And it feels sort of very short term and early days into this quarter that we're going through something similar at the moment since the reversal of the budget. Now, I mentioned earlier that certain parts of the UK market have been impacted more by the fact that we're in recession, and smaller companies tend to be more impacted than others during periods like that. And you can see here that if you invested in AIM, which is the smallest part of the UK market, you would have lost around a third of your wealth this year just investing in that part, compared to just a small loss within the FTSE 100. And that's because these companies are more exposed to what's going on with the UK economy. So what has that left on the left-hand side of the current valuation within the UK? So this shows the FTSE All Share, and it's the PE ratio. That's the price, the share prices of all the companies in the FTSE All Share divided by the actual profitability and earnings that those businesses generate. It's a very common financial metric to see how cheap or expensive markets are compared to the average or in the past. And this is what's happened over the last 20 or so years. We came into the beginning of this century with valuations very high. That was the tech bubble that was triggering valuations to be very high. We went through a period of derating and fall when the financial crisis really pushed that level even lower. We've then had a subsequent bounce back. We had the COVID wobble, which you can see very briefly there. And more recently, you can see how cheap valuations have got to the end of September, to the point now where the UK stock market looks as cheap as it did in the financial crisis in 2011 and is even cheaper than COVID. Now, that is staggering. That is staggering because all of those 3 points have been very good times to buy the market. one of the best investment strategies is not to overpay and to buy things on the cheap. And that's exactly what you're doing at the moment within the UK. And we see this not just at the overall market level, but from individual companies. And the right-hand side, it just highlights why the market has been weak this year. It's been very narrowly led. If you've only had to be in oil companies really to deliver a positive return. So BP and Shell this year have delivered record profits because of the fact that the oil prices increased so significantly and the costs associated that they take out the ground haven't increased. So it's just pure extra profit to them. But every other sector, apart from basic materials, has delivered a negative return this year. It's been very indiscriminate across the board within the UK. Now, that's all very short term. We've talked about what's happened in the market this year. I want to just take a step back and just look what global markets tend to do over the long term. All global markets over the last 10 years have delivered a positive return, some greater than others. I mean, if you've been in Hong Kong, the Hang Seng market, you've only delivered a 15% return. If you've been in the FTSE 100 over the last 10 years, it doesn't feel like it, but you made 75%. So you've almost doubled your money from being invested in the FTSE 100. And it doesn't feel like the market's raced away. And as I've just highlighted, it looks incredibly cheap versus its own history. The US has been the place to be because of technology, but clearly that's been a little bit more volatile over recent months. And you just got a growth index there and just see the impact that US growth has had more recently. The other point of just showing this chart is just to show what happens when you zoom out slightly. Now, COVID felt terrible when we were going through it. It felt like the markets have fallen significantly, and that's what it feels like when you're going through periods of volatility and uncertainty. It feels that markets are very weak, but look at that period now on the chart. It looks like a speed bump. It looks tiny, and when we fast forward the clock in 10 years' time and we're showing what happened in 2022, that'll be exactly the same, because this is what happens in markets all the time. If we go back and look at the financial crisis now, it barely even registers as a move, but the FTSE actually fell 50% that year. So it's zooming out, and the long-term impact of investing has a big impact. And just the final chart I'll show on that is that we're probably nearly a year or so into markets being weak. The average period for a bear market is just over one year, 1.1. And they tend to be very short-lived because you get policy responses. Look at all the different types of markets that we've had over the last, this goes back to 1945. So the last 80 or so years, we've had significant impacts. We've had Black Monday, we've had oil crisis, we've had tech bubbles, we've had financial crisis, we've had COVID, we've now got inflation. We go through periods like this all the time, and yet there's always a recovery after periods of volatility like this. And when the recovery does come, you can see it tends to last for a long period of time, and the numbers behind it tend to be quite significant. So just wrapping up, because I'm conscious of time, it probably doesn't feel like it today within the UK. Inflation moved a bit higher, but it's likely peaked in the US. The US has seen 3 months of decline from inflation, and it would likely fall as we move into next year for the reasons I mentioned in terms of commodity prices falling and supply chains start to be fixed, and the fact that demand is likely to be weaker because of the fact that we could be in recession. Interest rates are going to continue to increase, but not to the levels of the 1970s, 80s. And as I said, I don't think they'll get to the levels they were in 2007, 2008, for the reasons I mentioned, that we have such high levels of debt within the UK and globally at the moment. Economic growth is certainly deteriorating, but we're not in a global recession. It's not forecast that we're going into a global recession by the IMF at the moment. And when we invest, yes, we look at what's happening in the UK, but we invest globally. And as I said, 70% of the earnings in the FTSE 100 are derived from overseas and not the UK. So think about what's going on globally just as much as what's going on within the UK. It feels incredibly uncomfortable right now. We fully understand that. And if you ever want to discuss what's going on with your own personal circumstances or your portfolio, then please don't hesitate to be in contact with a member of Pareto or Luna. But that being said, it's important right now to think longer term. As I mentioned from that valuation chart, the UK is trading very cheaply at the moment, which has tended to be a very good entry point into markets. We can't call the exact bottom, no one can, But it's like from that chart, it looks like we're closer to the end than the beginning in terms of stock market falls, particularly for the FTSE All-Share. Think ahead. So it feels gloomy now, but the markets look forward 6 to 9 months. And when we're thinking about investing, we're looking forward to 6 to 9 months. And as I said, if we're doing that now, we're looking into the middle of next year, and we're thinking about what's going on in the middle of next year, and inflation's starting to come down significantly at that point, and potentially the economy coming out of recession at that point as well, if we technically are in it now. So that's all from me. I'm going to stop sharing. I've noticed we've had a couple of questions from Stuart come through already. Over to you.
Thanks, Alex. I know that must have been quite tough, considering everything that's been going on over the last 3 to 6 months. There's a couple of questions, as I say. The slides will be made available, and also the, as I said, the presentation's been recorded, the webinar's been recorded, so we'll make that available as well, should anyone wish for it. One of the presentations, one of the questions with regards to the presentation, it starts great presentation, so that's down to you, Alex. Given the Chancellor's given the new Chancellor's downbeat assessments earlier this year, on balance, Alex, do you think there are more reasons to be cheerful or gloomy at the moment?
It's very easy to feel gloomy. That you just have to look at the headlines every single day to feel gloomy at the moment. A bit of press help with that. I think if we are going into a recession, then we probably talked ourselves into it as well. But as I said, I mean, it's important to detach what's going on with the overall economy with what actually the market impact would be. And we saw this in COVID, and we saw this in the financial crisis, that ultimately there is reaction from politicians or central banks to stimulate the economy. It felt gloomy in COVID, and you look back now and it's like, well, it seems like it never happened to a certain extent now, almost 3 years down the line, because people adapt, companies adapt. I think that's the one thing that's really shone through and been a positive from COVID, is how quickly individuals and businesses reacted to the environment that we're in at that time. And at the moment, definitely there's headlines to come through, but it's interesting. I mean, we invest in Diageo, who make Johnny Walker Label, Guinness, a number of different alcoholic beverages. And they have been able to increase prices this year, but have also maintained demand. So they've seen a strong growth this year. So if you've got a good management team behind that business that can increase prices ahead of inflation, that are still seeing their goods wanted, then you're a good business. And we're seeing that with a number of the companies that we invest in at the moment. Greggs, Dunelm, you wouldn't expect retailers to be doing well in this environment because, we're going for a cost of living crisis. But their management teams are being able to negate the impact that we're going through. And they're increasing year on year. So they're increasing their revenue and their profits at a time when everyone's telling you that's not possible, which is incredibly interesting to see. But their share prices aren't rewarding them for that at the moment. Their share prices are still down anywhere between 30 and 40%. And that's the sentiment-driven market that we're in at the moment. Just another example. ITV, it was rumoured at the weekend, might be selling their production business, and the rumoured value of ITV Productions, and that's for producing shows like Love Island, which I know Stuart watches religiously, and The Bodyguard, which I thought was fantastic, but they produce shows like that and they sell them globally. And the value that they put on that business was $2.5 billion. I don't know if they will or if that's actually going to be happened. But the value of ITV as a business, their market capitalization is $2.5 billion. So what you're saying is one part of the business, just one part, equates the current value of that whole business. That's crazy. That's just purely market sentiment, which is so weak at the moment. And the reason that ITV have decided to potentially sell is just because they want to support their share price. They want their share price to move higher, and they're looking at ways to be able to do that. And selling a key asset like that unlocks a lot of value and can move the share price higher. So that PE chart that I showed on the FTSE All-Share, I think ITV's PE is about 6 times. So that means you've got 6 years of earnings till it pays for itself. Now that's incredibly low. I think it yields as a dividend yield around 7%. So you can just buy it today, hold it for a number of years, and as long as they don't cut the dividend, you're going to make 7% purely on the income and the dividends that you get. That's just gives you an idea of kind of how much has been priced into markets this year and how individual companies in the market as a whole has fallen.
So effectively, volatility creates opportunity, maybe not now, but looking forward.
Absolutely, and it's not just within the stock market, it's in with the bond market as well. I touched on it within the presentation. For the first time in 15 years or so, we've been buying more government bonds. So government, and they don't even need to be long bonds. Last week we're buying government bonds that matured in 2 or 3 years, which were returning 4.5% a year. So, well, the first thing is that's higher than you're getting in the bank account. In 2 or 3 years' time, those will mature. So there's certainty around the government being able to buy those back. The only problem is the U-turn by the government has meant that you can't buy them at 4.5% anymore. You can only, they've fallen already. So in the very short term, it's worked very well, but you could still buy them at, I think it's around maybe 3.5% to 4% today. But just highlights that opportunities always arise. Volatility actually presents opportunity within structured products as well, being able to invest in stock markets at lower levels and get higher coupons from the volatility from it. So it's not just in equity markets, there's opportunities everywhere, from individual companies to different stock markets to different asset classes that is thrown up during periods like this. It's also a period when we're at our busiest to communicate as much as possible, but also a trading and activity level within portfolios as well.
Well, this is one of the questions that's, excuse me, I was going to ask on behalf of some of our clients at Pareto who, and it's probably the question that we're getting asked as advisors as opposed to investment managers at the moment. What are the options for the cash that I've got sat in the bank? Now, you've just touched on certain different structures, such as structured products, but I think it's safe, and obviously you can go direct into the markets, but I think it's safe to say there are opportunities out there and there are alternatives to leaving your money in cash with inflation. Even if it does reduce next year, it's not going to come down to the lows that we've seen over the last 10 years. So people have to start thinking about the harsh reality of the impacts inflation will have in terms of the true purchasing power of money that's just cash even over the short to medium term.
Yeah, I'd agree. I mean, the number of opportunities for cash options now has increased significantly, and that's linked to what's happened with interest rates. Interest rates moving higher and likely to move higher. It means that you can get better returns on different asset classes. You know, we've not looked at 100% capital protected structured products, for example. You're still exposed to the counterparty risk of the bank and the bank failing, but banks are in a lot stronger situation now than they were in the financial crisis. But the last time we were looking at those products was 2006, 2007. But the returns on them are now very attractive. Government bonds look attractive. You can take a little bit more risk at corporate bonds, and you get a slightly higher return. But you know, some short-dated corporate bonds look attractive. So there was definitely a lot of opportunities where you can get a higher return on cash at the moment, but not necessarily have to take a significantly amount of more risk. They're certainly not going anywhere near the equity market if that's what the concern was anyway.
Okay, and I know we're short of time, so just quickly, the last question. Is a reality that the period of low interest rates, low inflation that we've enjoyed over the last few years may be a thing of the past, and we might just need to accept that inflation might be a little bit higher, but interest rates also for a generation has been exceedingly low. And actually, if we look back at 5%, 6%, then they're not actually that high interest rates.
No, and well, as I said, I think maybe interest rates get to 4% at the height. Inflation has increased very quickly, but I think it's going to be a bit sticky to come down. So food inflation is now starting to come through. There's mortgage costs that will start to impact the figures, which are clearly some, and rent will start to go up if mortgage values are going up. So that's to come. But that being said, the two primary drivers of inflation this year have been oil and natural gas prices, and they look like they're turning. The oil price has already turned. It's already fallen by almost a third. natural gas prices. Well, the government have held that now for 6 months, so that reduces the impact that we feel on consumers for that a little bit longer. I think they'll probably end up doing something in April next year anyway. So the impact that it's going to have going forward is become less and less, which means inflation will come down. But yeah, you're probably right. We've been in a world of maybe inflation running at 2%. Maybe that's 3 to 4%, and interest rates need to be slightly higher to battle that.
Okay, good. Thank you. Alex, thanks for your time. For everyone, as mentioned, with Pareto and the way that we look at investing our clients' funds, it isn't a well-diversified portfolio that Alex has touched on during his presentation. And that's the aim to maximise returns and mitigate the volatility. However, we should be conscious of short-term volatility, but not at the expense of our clients' long-term needs and objectives. Alex, I'd like to thank you for presenting today and everyone for dialing in. The next quarterly seminar is going to be in January, post-Christmas, where we hope you can all join us. I'm not going to wish everyone a happy Christmas and New Year just yet. But if there is anything that you'd like to ask, if there's any queries with regards to various options in terms of investments or alternatives to cash, or where we think the market's going, please feel free to speak to myself or your advisor at Pareto, and if you want, we can put you in touch with anyone at Luna. So thank you for your time. I hope you have a good day, and I look forward to seeing you in January.
Thank you. Bye now. All the best.